Welcome back to Businessline. We have the pleasure of Aarti Krishnan's company once again, the head of Research Bureau at the Businessline newspaper. She was with us last week when we started our first discussion on mutual funds. Today we are going to take up from where we left off. Welcome, Aarti.
Hello, Rajiv. Last week we discussed some of the basic concepts about mutual funds. Let's go a step further this week.
Fantastic. So let's dive right into it. Aarti, tell me, how are growth funds different from income funds?
Growth funds is a term typically used to describe funds which invest in equity or equity-related instruments. Income funds are funds that invest in debt instruments, government securities, corporate bonds, and a whole range of other debt instruments. Typically, income funds need not give you income and growth funds need not give you growth. As I told you last week, much depends on how the underlying securities perform in the market. You may ask me how an investor can choose between growth funds and income funds, for example. Because the income funds invest in debt instruments, they are typically for investors who are more conservative, who are more keen on the safety of their capital, whereas growth funds are for investors who can take on equity risks.
So let me understand how these funds are constructed also. So help me understand this. Overall constituents of each fund is the same list of 6,500 stocks.
That's right.
One type of funds would be growth, the other one would be income. And somebody is managing to make the difference for us.
No, actually these are two distinct categories of funds. Growth funds will invest in the 6,500 stocks that you mentioned. Income funds will invest in a completely different market, the debt market, where government securities are traded, the corporate bonds are traded, the money market instruments are traded.
The investor decide which one's right for them?
It would depend on three factors basically. First would be his risk profile. If he is able to take a considerable volatility in his investments and if he can take on capital erosion also, then he can consider equity funds. Whereas if he is really keen on safety of his capital and low volatility, he should go for income funds.
And Aarti, to determine these factors, is that something that people just know in their heart? Is that a gut reaction, or should they actually sit with the investor?
A lot of factors actually go into deciding what your risk profile is. Actually, there are a whole set of questions that you run past the investor to gauge his risk appetite. Though the general thumb rule is that young investors can take on more risk because they have more earning years ahead of them, it's not always necessary that young investors have the stomach for risk. There may be older investors who are willing to take that blip in their capital from time to time. So you have to run the entire details of your net worth, of your ability to save, of your future plans past your financial planner, and he can tell you how much you should allocate to income funds or to equity funds.
Just generally, who should invest in equity funds?
Yeah, that's a good question because we frequently get letters from investors who have gotten into equity funds without really understanding the risks involved in them. I would typically say three kinds of people can get into equity funds. People who can handle some capital erosion. If you put your money into equities, you should be prepared to see 50% of that wiped off during some periods in the market. That's a bit drastic, but that's what happened last year, so investors have to be prepared for that. The second thing I would say is that equity is generally suitable for younger investors because younger investors have several years of earnings ahead of them. They can wait out any blip in the stock market and wait for a recovery to happen so that their investments are repaired over that period of time. The third thing is an investor should have a minimum 5-year horizon to invest in equity funds. Because if you look at people who invested in equity funds in 2006 and wanted to pull it out in 2008, for instance, they would have had to pull out that money at a 30 or 40% loss. Now, if you could wait out that period and see the recent recovery, you could have made a lot of money on your equity funds. So typically, you need a longer horizon. If you need your money within 3 years, best to stay away from equity.
Now, again, the previous criteria, in the previous question you said there are different ways of ascertaining what's your profile like. I'm sure those profiles and those criteria would still apply to these types of investors. Whether young or old, there would always be exceptions. You have to take a look at what's your actual financial situation.
Yes, exactly. I mean, apart from being young or old, there's a mindset change which needs to happen if you need to accept the risks of equity investing. The second factor is that even though you may have very high levels of income, you may have high debt as well. Suppose you borrowed, you've taken a huge home loan and you need a good portion of your income to pay off that home loan. then you cannot afford the risks of equity investing. So a lot of other inputs also need to be taken before you can decide whether you can go in for equity investing.
Of course, you pointed out in our last episode that there are experts available that people could reach out to. They can choose to, and correct me if I'm wrong, they can choose to invest themselves if they'd like to. There are online places available for people to do that, but you would advise them to go work with an advisor.
Yeah. He should first plan out his asset allocation. That is, how much of his money he can afford to put into equity, how much of it he can afford to put into debt, and how much he can leave in liquid instruments for emergency purposes. That basic exercise has to be completed. If he can do it on his own, it's great. Otherwise, he'll have to consult a financial planner to get that plan in place and then move on to the choice of funds and the types of funds.
Fantastic. Now let's take an example. So I am a 21-year-old. I just graduated from school, and by the way, that's a whole lot of our audience. So let's say I just graduated out of school, got my first job. Where should I invest money now? I have a full career ahead of me, my whole life. I don't have a whole lot of investments. I might have some debt, some loan I might have taken from a bank to fund my schooling. Where do I start?
You can start with a very small investment in equity funds, because you do have several years in which to save, and you may have many financial goals, say 5 years or 10 years down the line. Suppose you want to save for higher education, say 5 years down the line, or you want to save towards a foreign trip, for example, 10 years down the line.
We're talking about foreign trips, we're talking about education. Let's also talk about the magnitude of, what kind of fund requirement would there be? So entry level for that kind of a student who just came out of school, what level do they start at?
You can start your equity fund investments for as little as 500 a month. For these kind of people, I would typically advise that they do not put in a whole lot of money at the first go. There are various plans available, like systematic investment plans, where you can phase out your investments over several months. So you put in 500 each month, and that builds up into a fairly sizable corpus later.
How would one fund be different from another? What should I look at?
There wouldn't be much differentiation, especially if you're looking at various index funds which are tracking the same index. There wouldn't be differentiation, but you can take heart from the fact that there are so many indices to replicate. You can replicate the Sensex, you can replicate the mid-cap index, the BSE 500, there's a junior Nifty. You can also replicate some stocks, sector-specific indices like the BSE banking index and so on, so that you get focused exposures to these. On evaluating index funds, I would say that the expense ratio is a key thing, because there's no differentiation coming from the fund management part of the index fund. You have to look at the index funds which are available at a low expense ratio, so that the cost that you're paying to the fund manager for managing that fund, which is basically a mirror product, isn't very high.
Thank you, Aarti, for being with us on the show. Look forward to seeing you again next week. Stay tuned. Businessline has more in store for you in just a short while.